In this video, we're going to discuss how to put in rental income on a tax return. So you would go to your income screen, Rents and Royalties, Schedule E. Just check Begin. This box here, you're very rarely going to check. You're going to hit Continue. Okay, so it wants to know the type of income you have. We're going to say this is single family residence. Description, normally I put the address here, so we'll say 243 Smith Road, and then again 243 Smith Road and the zip code. Okay, percent of ownership is 100%. Rental payments received, this is basically how much rent you received all year. So if you receive $500 a month, that would be $6,000 per year. Enter the number of days the property was rented at fair rental value. That's usually 365. Just ask your customer. Enter the number of days the property was used for personal purposes. That's usually 0. I have seen times when there were some days in there, but usually that's 0. Check here if you're a member or of a qualified joint venture. This one is important. Check if you actively participated. So to be able to deduct expenses and stuff, you need to actively participate. So I want to make sure you check that. And that's usually the only box. I haven't checked that one in a while. Hit Continue. And you've got your income in there. Now you want to go to your expenses. You can depreciate the property. Basically under depreciation, you want to make sure that it gets depreciated, so they get that expense. Description of the asset would be a house and land. Date placed in service. So let's say they just got it last year, January the 1st. And this is what they paid for it. We'll say $150,000. Percentage of business use is 100%. I usually don't put anything under the 179 deduction. Prior year depreciation, if they're coming to you and they've already depreciated it but filed their tax return somewhere else, you would want to look at that tax return and see what the prior year depreciation was. In our case, it's going to be 0. Accumulated depreciation, again, the system will calculate that for you if you've been doing their tax return. If it's the first time you're doing it and they've had depreciation before, you should look at their tax return and add up the accumulated depreciation. Depreciation method, always on a house, it is 27 years, 27.5. Useful life, we'll say 30 years. Always make sure it's more than what's your depreciation. If it was disposed of, they sold it last year, then you would put that date in here. And this depreciation, if it's anything other than real property, so you've got auto, trucks, stuff like that, that's not the case in ours. So we hit Continue, and now we have depreciated the property. So we get that as an expense. So now we're going to go down to our expenses. And basically you're just going to get a list of what they spent and expenses to maintain the property, where they had to advertise it, if they spent anything for cleaning, and if there was more than one person lived there, if they had to do any repairs, goes here, supplies. So anything at all expense wise you would put in there. If not, you would hit Continue. And if you have any kind of car and truck expense where you had to go back and forth to the property, you would put it there. And that's basically it. Just hit Continue from there. You can add another rental property if they have more than one. And you have entered your rental property income and expenses.